Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey, everyone. Good morning. Welcome to the show. So a little update on what I'm seeing in the Bitcoin complex. We've been talking about these quite a bit over the last 4 or 5 months. Some really amazing trades in MSTR and Coinbase, some of our turbo trades that I teach in the programs. But kind of interesting what's going on out there in the sense that it's not very interesting, but I think that could set us up for something potentially explosive at some point here. We can see IBIT, which is the iShares Bitcoin ETF, really pretty much flatlining in here, starting to stare a little bit over the cliff yesterday, but we can see where the implied volatility, option pricing, and historical volatility have gone. So in the blue, we can see that option pricing has absolutely plummeted to pretty much the lows of the year, around 55 vol, which is very, very low for that particular product. And importantly, we can see this green line is the historical volatility, and it's sitting right on the floor here at basically zero historical volatility rank. And so we can see that in the other products as well. If we go to MSTR, we can see, look at this historical volatility rank. I mean, it's literally in the basement. It almost couldn't be any quieter. Look at this chart just meandering along here. We tried a long straddle, didn't work out, got stopped out a little bit, but we had a couple of great trades before that. So we're just kind of watching and waiting for some indication that things could be moving along. And let's look at some of those indicators that we can look at. Again, down here, implied volatility, meaning option pricing sitting in the basement. Historical volatility, the green line, really just continuing to fall, consistently. This is a 30-day measure, so it's still incorporating some of these moves in here, but really your 10-day volatility is almost non-existent. So very unusual for the sector. Similarly for coin, of course, which had earnings, and so it popped and reversed. So here we are again. Still, though, we see, of course, as expected, a drop in option pricing after the event, which is to be expected. But again, historical vol, very, very low, not quite as low as the other ones. But let's take a look at a couple of our metrics here. So we're looking at skew in these particular names. So here's your coin skew. Anything along the zero line here is showing kind of non-committal type behavior, right? The calls aren't really expensive. The puts aren't really expensive on a relative basis. Sort of nothing happening around that zero line. And so we can see as we went into early November last year, that's where we sat on the skew. No one was really placing any bets one way or another. And so let's go back and take a look at where we were. So there you go, sort of late in October, right in here. This is basically where nothing much was going on. We did have a little bit of a run up in coin, but then it settled down and the skew was kind of showing no particular interest in betting one way or another. Then we had this huge explosion. So I think that's kind of interesting because we are now getting closer to that zero line again. And as things quiet down, of course, we're moving up to that non-committal level of zero skew, which is basically neither here nor there, puts versus calls. What I'd like to see is a little bit of a move down below this support level in a sense, because you can chart this as we've done here. We can see this nice pattern. It's coiling, but it's got to break out. And my guess is that, of course, volatility is going to break out. Volatility tends to break out when these things start to move up. They're a little bit different from the other products, as I often mention. So we could see a move down into here, and this sort of bottom where we see call skew, very, very high versus put skew, will of course coincide with this kind of move. So this is where we saw it right around November 11th. We had this massive move and an exhaustion FOMO type reaction on the call side. Everybody just piling into calls. And that was pretty much the end of the run for there. So that's really kind of what I'd be looking for, a move back to this low level here. And then in fact, in MSTR, very similar, right? So we had this initial move back in March, which blew out the call skew, meaning everybody was piling into calls. They couldn't get enough of them. And so that was basically the top back then. Then, interestingly enough, that's the exact level we got to if we look at this period here in MSTR right here. That's the level right there. So we had this huge run up from basically the sort of 150 to 170 area all the way up to about 550, and that was the blow off top in that skew as designated here. And then we just started to coil again. So again, in MSTR, we've done this beautiful coil. We could draw another line along here, and we're up towards that zero line, which for me, as I've mentioned, that was my big indicator for my huge straddle trade that we did incredibly well on, was this move back to the zero line. So we got there the other day. So let's see if we can get up there, touch again perhaps, but ultimately what I want to see is a breakdown of this chart here, which is going to signify call skew starting to blow out versus put skew. That means people are excited. They're jumping into the upside potential, and they're starting to push up that skew, and that's going to sort of create a bit of a feedback loop, in my opinion, sort of the stock going up, higher call skew, feedback loop into the stock going up even more. So that's a reignition of those animal spirits that play out in the volatility complex. Now, one thing I would say is some people have been asking me, well, should I be selling options in these names? And I'd say I'm not that comfortable doing that here, right? So we talked about how the implied vol is almost in the basement, pretty much in the basement on these things, very, very low. That doesn't get me excited, right? So being a good option seller is often knowing when to not sell options. You've just got to be able to get a better feel for that. And there are certain metrics that we can use. You can look at historical volatility. You might say, listen, if we drop below the 25th percentile in historical volatility, you're not going to sell. Or if we drop below the 25th percentile in implied volatility, I'm not going to be excited selling premium. So you can definitely stick handle that situation depending on certain metrics that you're seeing, which I teach in all my programs. Looking for that range of where I'd like to see option pricing, because I truly believe, backed up by data, that the consistent money is really made between the goalposts, right? We're not trying to get too fancy outside those goalposts, maybe get too close to them, and the football bounces off the wrong way. We want to try to make the easier money. And right now, what I'm seeing is something that concerns me a little bit. Here's your implied volatility in the IBIT, the Bitcoin ETF, and it's much, much higher than the historical volatility. Now, textbook move here would be sell the heck out of volatility, right? Look at this. This is called the volatility risk premium. Well, how much more are people paying for options versus the underlying movement in that underlying IBIT? And it's massive, right? This is huge. So this is where the textbook would say, well, sell the heck out of this all day long. But what I don't like about that is when it gets super, super wide, that becomes a little bit of an alarm for me, as well as when we look at the IV rank sitting right down towards that 0 percentile. So when I talked about this in my volatility ninja series, which you get with all my programs, and this is a slide from that series where we talk about the volatility risk premium positive carry, and the positive carry tends to be really, really high when you're in an IVR between 0 and 20. So this is a low volatility environment, right? This is just by definition, low volatility coincides with, but typically, right, usually coincides with very low expected moves and very low realized moves. So this is very, very typical. You're not going to see IVR at 10 in a market that's swinging around like crazy. So, but what you get in those environments is the highest volatility risk premium, that huge positive carry, which is what I'm talking about here, that massive, massive carry. But what I worry about, and I go into much deeper explanations on this in the programs, but I worry that this is the area where you get breaks to the downside, right? You get sort of very quiet, slow moving upward markets, upward trending markets, but you get these breaks to the downside that can be very violent. And when you're short options at low levels of volatility, you also have something called short gamma that gets much, much more pronounced. So you're getting very little reward for your premium sales, but you're taking on much more significant risk of just one single news headline having the market move against you, and it'll move against you very, very quickly. So you're constantly, as an option seller, really balancing this idea of, well, how much am I getting? How much reward am I getting versus how much risk am I taking on? And so you have to kind of really understand that balance, because sometimes it's going to be lopsided to the point where it isn't quite worth it, even though that vol risk premium is nice and juicy. And that's technically what we're trying to capture as option sellers. We're trying to capture that, right? That's what gets you excited. The fact that options tend to be a little bit more expensive than, or a lot more expensive than, underlying movement. But remember, that is technically the case from a textbook standpoint. From a structural standpoint, options tend to be more expensive, but we have to deal with the reality of things being in flux all the time. There's something called path dependence. I can sell a put and maybe the vol risk premium is nice and juicy, but I still am short a strike. And if the market suddenly reacts negatively, and it can move through that strike rather quickly when we're dealing with very low levels of volatility. So we always have to recognize path dependence risk. So we have to kind of combine this view of, we're trying to capture something that exists much of the time, but also with a respect for what markets are doing. We don't generally want to get crazy in super high vol environments where downside breaks are huge, and we want to be much more careful in those low volatility environments where that positive carry is very nice. It's telling us, hey, sell the heck out of me, but we want to be a little bit more focused on those areas where where we have those sweet spots. So hopefully that's good for you. If you guys like this and you want more, please subscribe below, like below, and check out my programs. I've got another program starting, live program in March, and I've got all sorts of other goodies happening, as well as an amazing community where I teach people about all this stuff, and we're nailing it and doing great stuff every single day. So have an awesome day, and careful out there.